on our agenda today. We're going to start off by describing the benefits and terminology that's related to standard costing and reviewing everything you need to know about the setup and so on, just like we did for all of the other costing methodologies that we covered in part 2. Then we're going to switch gears and discuss how the costing sheet is used. We're primarily going to be focusing in on how it's used with standard costing, but it can be used with any costing method. We'll show you how to perform cost calculations and review the results with a couple of demonstrations, and we'll discuss other considerations that you should think about for costing. We'll wrap up as usual with our do's and don'ts and resources to help you on your learning journey. So with that, I am going to hand it over to Anne to kick us off today.
Thanks, Rachel. Let's take a dive into standard costing as a costing strategy in D365. In our last Tech Talk, we went through the different cost models available to perform actuals and average costing in Dynamics 365 supply chain management. In this Tech Talk, we will begin by diving into standard costing. Standard costing is a strategy where we assign the same cost to every transaction for an item, both the receipt and the issues. So what is standard cost? Standard cost is a predetermined cost that we define in the system to be used when transactions are posted. Since the final cost is known at the time of transaction posting, this means that standard cost is a perpetual cost model, as we mentioned in our first Tech Talk in this series. This means that the inventory close process is not required, but is still recommended as part of the period end process to prevent backdating of transactions. Standard cost is based on past experience and is sometimes referred to as a common sense cost, reflecting the best judgment of management. Standard costs are typically determined annually during the budget control process because they are useful for preparing flexible budgets and conducting performance evaluations. In some industries, it is common to set standards on a more frequent basis. In most cases, standard costs are compared to actual incurred costs on a periodic basis and updated based on factors that may be changing in the industry. The difference between standard cost and the actual cost of a transaction is called a variance. For proper control and performance measurement in an organization, variances should be measured and analyzed to determine standard cost accuracy. To understand better how standard cost works, let's look at the following example. In this chart, we have 4 purchase transactions for an item that is set up with standard cost. The first column for each PO shows the actual purchase price per unit of the inventory. Notice that it varies from transaction to transaction, as purchase prices often do. The second column in purple represents the standard cost we've assigned to our item, which is what will be posted as the cost of the source transaction in D365. While the example we show here is for a set of receipt transactions, the same concept is true for issues. The standard cost price we establish will be used as the cost for every issue transaction as well as the receipts. The difference between the purchase price and the established standard cost results in a variance, which is represented by the yellow columns and is posted to a purchase price variance account in this case. Issue transactions do not result in price variances since the cost used for the issue is the same as the cost used for the receipt. Variance is typically analyzed as a total over multiple transactions, which we can see here represented by a total variance of -$1.50. This would imply that on average, our purchase order prices are lower than the established standard cost. A positive variance would indicate that our actual costs are mostly higher than our standard cost. If we have a high positive or negative value in our variance account, that is an indicator of an inaccurate standard cost, which can impact how our margins look in the balance sheet versus in our P&L. In short, we want our standards to be as accurate as possible, so we have a true representation of our margins and can set adequate sales prices to hit our profit goals. Let's talk about how to know if we should use standard cost versus other cost strategies, which are actuals and average costing. Standard costing is typically the preferred costing method used in manufacturing environments, whether they be discrete, process, or lean. The first thing we want to think about is how much our prices fluctuate. If they fluctuate frequently, do you want that to be reflected in the cost of specific transactions? An actuals or average cost model will reflect the impact of variance in price on a transaction-to-transaction basis. If you use standard cost, you would have to update your standards very often to reflect price changes on your individual transactions, and so standard would not be the recommended approach if that was your requirement. However, if the variance in a period more or less evens out over time, or you want to keep your margins constant throughout the period, regardless of price fluctuations, standard costing may be a better fit for your business model. Next, you will want to consider where you want your variances to be reflected. With average or actuals costing, variances are included in the total cost of transactions and are not broken out separately in the general ledger. With standard cost, each different type of variance can be posted to a different general ledger account, allowing businesses to see clearly the main sources of cost variance in their processes. We will dig into this concept more later in this session. The third main consideration for choosing a costing strategy is to think about how different items may behave differently and therefore should have different models. For example, it is not uncommon for manufacturers to use actuals or average costing on raw materials while using a standard cost strategy for finished goods. This allows us to reflect price variances on purchased materials in the inventory value, but does not let that variance impact the margin on our sales orders since the finished goods would post at a standard cost. Now I'm going to hand it over to Rachel.
Thanks, Anne. In order to understand how standard costs are calculated in the system, first, we need to look at the costing sheet setup in Dynamics 365. The costing sheet is almost always used by companies who run standard cost, but it is also used for companies running other cost models. Our discussion today, though, is going to largely focus around how it's used by standard costing companies. Imagine with me for a moment. In a world where you have bill of materials with hundreds or even thousands of lines and multiple levels, and your job as the cost accountant is to analyze those costs. When you have a bill of material or formula with hundreds of lines, lots of levels, even thousands of lines, it's really difficult to understand where those costs are coming from. If you can group similar items together, you can get a summary of your ingredients separated from packaging and labor and so on, as an example. This is where you can use cost groups in Dynamics 365 to help create this logical grouping. So let's start with an overview of cost groups. The cost group is designed to help you segment costs and analyze the costs that contribute to the overall or total cost of an item. This includes material, labor, and overhead costs. The industry terms cost breakdown, cost decomposition, and cost classifications are synonymous with cost groups in Dynamics 365. Cost groups are applied to both planned and standard costs and give visibility into the source of costs in a total cost calculation. Each cost group must be assigned to a cost group type. If you select direct materials, the cost group can only be assigned to released products. Likewise, if the cost group type is set to direct manufacturing, you can only link the cost group to a cost category. If you select the undefined option, this gives you the flexibility to assign the cost group anywhere. You can also select direct outsourcing to separate service items from outsourcing for your standard materials. You can also optionally specify a behavior on each cost group. This helps to further classify the group as fixed or variable. While this setting does not change the behavior in the system, it can be used to further segment and analyze costs. If you leave the field blank, the system will treat the cost as a variable cost. When we think about fixed cost versus variable cost, it is the difference in categorizing your cost as either static or fluctuating. When there's a change in the activity and volume on your orders. In most cases, your costs are variable, which means they scale with the size of your order. You would use fixed if you add a flat amount, for example, through an indirect cost. Each cost group can have multiple profit settings defined on the Profit Fast tab. These profit settings are useful when running BOM or formula calculations to increase the cost of items, labor, or indirect costs by a percentage. The default and typical standard profit setting is set to 0. unless you want to increase the cost of an item or labor component in a cost calculation by a percentage when you calculate the costs. 3 additional profit settings can be added, named 1 through 3 respectively. If you decide to use these, we recommend that you define a business purpose for each. For example, profit setting 1 might be used for what-if analysis to simulate what a planned cost increase would look like. When you're considering how to configure your cost groups, you'll want to focus on each type of cost group. So first, let's start with the considerations for materials. First, you'll want to at least create one cost group for internally sourced products and one for outsourced services if your organization requires. Beyond that, you may be wondering what types of cost groups you should create. While there is no single right answer to this question, think about the types of materials you use in your organization. For example, if you are a food manufacturer, you may want to break down the materials into raw ingredients and packaging. While if you manufacture electronics, you may want to create cost groups to break down subcomponents and packaging. If a particular component has a higher cost in your manufacturing process, you may want to create a cost group specific to that one item or type of item. Again, taking an example of a food manufacturer that, say, makes dairy products, you might create a cost group specific to the milk, another for ingredients, and then packaging components. While an electronic manufacturer might create one group specifically for processor chips, which are higher in cost and variability, and you might also think about the various departments that consume the items in your bill of material or formula. For example, let's say you manufacture RVs. You might group appliances, furniture, wood, and exterior materials. The last consideration for your material-related cost groups is the overheads that will be added to your items. If some products should get an overhead and others shouldn't, you'll need different cost groups. If some items require a higher overhead, for example, imported products or frozen products, or products that require special handling and quality, you can separate them into their own cost groups. Now, the next set of considerations are around your cost groups for labor. If you don't manufacture anything or you don't use routes in your production process, you don't need to create any direct manufacturing cost groups. But if you do, you'll want at least one cost group. Additional cost groups can be broken down for additional detail and reporting by a number of different things. The first consideration is for the resource types. For example, you might create groups that represent machines or equipment in your production process, and then separate the human-related costs from the outsourced vendor processes. You may also want different groups for the location where your materials are stored. For example, you might separate refrigerated from freezer and dry locations. The next consideration is for the resource costs. You may want to separate higher cost resources from lower cost resources so that it's easier to analyze the production variances. In this case, let's say, for example, you have a new laser CNC, and you're also still using your standard CNC and other equipment for your production process. The new laser costs millions of dollars, and the cost accountant needs to analyze variances on this new machine closely to ensure that the machine is operating efficiently. Much like materials, you'll want to consider your overheads on your labor. So when you're considering overheads on your labor, each different rate that needs to be added will require a different cost group. We'll talk more about examples later. Lastly is the segmentation on considerations for your labor-related cost groups. When we think about segmentation, it really comes down to a business preference. You'll want to think about the level of detail versus summarization that you want in the costing sheet. Examples of ways that you might segment your labor is by a department or a work cell, for example. Lastly are the considerations for your cost groups related to indirect costs. Indirect costs are used to calculate overhead costs on your purchased and manufactured items. If you plan to add overheads into either purchased or procured items, then you'll need at least one cost group for indirect costs. When deciding how many indirect cost groups to create, you'll want to follow these considerations. First, you'll want to consider the types of overhead, such as machine, human, vendor, or building related. Each calculation method will need a different cost group. Dynamics 365 supports a variety of calculation types such as surcharge, which is a percentage, rates, which are flat amounts, and we also have options for input and output unit based. These are based on the quantity of an item that are issued to a production order or the quantity of something that you report as finished or that you've produced. Next, you'll want to consider the accuracy level of your overheads. For example, let's say you want to add a building overhead and you have 3 different facilities. You can create one cost group and one cost code for each one, or one total cost group. If the costs are the same across all 3 buildings, this is not a concern. If the calculation or rate is different, then you'll need one for each different calculation and rate you want to define. The next consideration is for a build versus buy in relationship to your materials. Keep in mind that you might sometimes produce an item and other times outsource it. If you need different overheads in these situations, you'll need at least one cost group per type at a minimum. If additional are needed for reporting or reconciliation, you can create additional cost groups. Lastly, you'll also want to think about the reconciliation process and how the costs should be represented in the general ledger. Each cost group can be linked to one cost category, and each cost category can have its own accounts for general ledger postings. If you need to financially report against 3 general ledger accounts, you'll need at least 3 cost groups to map to those 3 GL accounts. So let's switch gears to the costing sheet. There are some important facts to know about costing sheets before you start configuring one. The costing sheet's primary purpose is to define the format or layout for your costing groups. Each legal entity has one costing sheet and only one per legal entity. Next, it is important to note that only one person can open and edit the costing sheet at a time. If you need to add overheads for indirect costs, a costing sheet is required. After you make changes to the costing sheet, you must validate the costing sheet to check for duplicates and any missing configuration before the changes are saved and made effective. Lastly, the costing sheet can be thought of as a hierarchical representation of your cost groups used for reporting and variance analysis. So, knowing that a costing sheet is a hierarchy, there are several different types of nodes or elements in the costing sheet. Let's switch over to the system and take a look at a sample costing sheet for our Purple Pillow Company. So, I am here in the costing sheet page. It is found in the cost management module under the indirect cost accounting policies setup area. The first node you see here in the tree is called the root. You must have one root node and it must be first in the costing sheet. In our example, we have named it Purple Pillow Company Costs. The next type of node is the price node. There are typically 2 price nodes, one for cost of goods purchased and one for cost of goods manufactured. In our example, we have named the cost of goods manufactured as cost of conversion. If we expand each of these nodes, the next type of node is our total nodes. Now you can create as many total nodes as you want. This is where your detail level and summarization level may vary from organization to organization. You can select if there should be a header and total displayed on the costing sheet. Total rows will show a sum of everything you put under the node. In our example, we have a total node for purchase products called COP material and another for overhead on purchases. Then for conversion, we have 3 total nodes for material, labor, and overheads respectively. Once you have your total rows, you're ready to add the bulk of your costing sheet, which are the cost group nodes. Each node links to one cost group, and generally you'll want to include all your cost groups somewhere in the costing sheet to ensure that when you look at the costing sheet or cost breakdown, you get a full view of costs. If you omit a cost group, the costing sheet would show an incorrect total. In this example, you can see we have materials expanded for cost of purchase with 4 cost groups for fabric, billing, fixtures and notions, and packaging. You can also see that labor is expanded with 5 nodes. Each of the indirect costs include a total node as well. The last thing to do to your costing sheet is to add your indirect costs. These nodes can be one of 4 types, and the type you select changes the configuration that's required. The first example here is the transportation overhead on purchased items. You can see this is set up as a surcharge. You specify your absorption basis, enter your surcharge, which is a percentage, and then you can enter main accounts for the ledger postings and specify dimensions. The next example we will look at is the machine depreciation, which is set up as output unit based. You can see the node type is selected. There is no absorption basis, and this time you specify a rate, which is expressed as an amount. We will review what it looks like to use the costing sheet for cost analysis in our next Tech Talk. Now, I will hand it back over to Anne.
Thanks, Rachel. Once we've built out our cost groups and our costing sheet, we have the foundation for calculating our standard costs in the system. Let's take a look now at the process of cost activation and maintenance in D365 supply chain management. Before you can start creating or calculating costs, you'll need to create one or more costing versions. The primary purpose of a costing version is to contain cost records about items, labor, and indirect costs. By having multiple costing versions, we can track the history of the standard costs we have established in the system. Costing versions can have a type of standard cost or planned cost. The standard cost type is used for the costs that are active in the system and will be posted in transactions. The planned cost type is used for running simulations on cost and does not impact the cost of transactions. A costing version can store item costs, cost category prices, and indirect cost calculation rates. While we will focus on item price calculation and activation today, we'll talk more about cost categories and indirect cost in the Tech Talk on manufacturing accounting. We have a number of functions available to run on a costing version. We can copy all of the prices in one version to another using the copy function, which can be useful when we have simulated planned costs that we want to add to a standard cost costing version. We can run a mass costing calculation for a costing version using the calculation button and activate all pending prices in a version using the activate button. For each costing version, we have 2 blocking policies. The block field tells us whether we allow a new pending price to be calculated or manually entered in that version. The block activation field determines whether we can activate pending prices or not. We recommend for the costing version that is active for your current period, once you've created and activated the prices that you will use, you should block both the creation and activation of new prices. This prevents uncontrolled changes to the prices that are actively being used on transactions and preserves the history of previous costs. These flags can be changed at any time as needed. There are several approaches to how you can set up your costing versions. There is no one right way to configure them, but there are some common patterns and approaches you might consider. One approach is to use a costing version per year or per period that you set new standards. For example, the dairy industry uses a standard cost that is set by the government here in the US, and the cost is established each month. So they could create a new costing version for each month in the year to track costs over time. You could also add a revisions costing version to track costs that have been updated outside of the normal maintenance and activation process. Another approach to costing versions could be to simply have an active costing version, which is updated each time you set new costs, and a second planned costing version for simulations if needed. This approach reduces the visibility to historical costs, but means that you can have fewer costing versions to create and maintain. Now let's talk more about the item prices that are contained within a specific costing version. Here we have a screenshot of some of the item prices in our 2022 costing version. The first thing to note is that the system separates active prices from pending prices, as you can see. The pending price view is used to create new costs and review calculations before confirming that they're ready to be used. Once they're activated, the price will move from the pending view into the active tab, where it is no longer editable and is used on active transactions. If a price has been activated but needs to be edited, we must create and activate a new pending price instead. When choosing which cost to use in a transaction, the system will select the most recently activated cost price. When setting cost prices for future periods, we can set a from date on the price to denote the starting date for that new price. It is important to note that site is a required field on our costs in the system. If we have multiple sites, we will need to set a cost for each site that we have. Additionally, if we are using product variance and we have enabled the flag for cost price by variant, we will need to set a cost for each combination of product dimension values. The next several columns in the grid are used to store the cost price information. First is the price field, which contains the base price. The price is active for the quantity in the price quantity field, i.e., that is the price for that number of units of that item. For example, in cases where we need to track price to 4 decimal places, we can set the price quantity to 100 and then set the price field to be the equivalent for 100 units and only need to go to 2 decimal places since our price quantity is 100. You can also optionally add price charges, which can scale on a different rate than the price field by using these price charges and charges quantity fields. When we run cost calculations, we need to use a calculation group, and we can do that one of 2 ways. We can either create multiple groups and assign them to individual items, or we can set a default calculation group in the inventory and warehouse management parameters page. Calculation groups are used to define things like which costs are used for calculation and what warnings we want to see if there's missing information in our calculation. Now let's take a look at a demonstration of how the costing version, calculation, and activation work in the system. Here we have our list of costing versions in D365. To view the list of items prices in the system, we'll click Price and Item Price for that particular costing version. We start on the Pending tab, but if we click the Active tab, we can see the active prices for that version. To create a new price, we have to be in the Pending Price view. To do a manual price, we'll click the New button, and then we can type in the item we want to set a price for, the site that the price will be active for, and what that price is. So I have the ability to do this manually. If I wanted to activate it from here, I could click Activate Pending Prices, but I want to calculate, so we're going to delete this item price. To run a calculation, instead of manually creating a price, we're going to go back to the costing version and click the calculation button. Here, we're going to select the site that we want to run the cost calculation for. And then we're going to look at the rest of the parameters. So we can create a cost price or a sales price or both, but we're just doing a cost price. Here we can see the warning flags if we're missing certain information or if any of our cost price are over a certain age. On records to include, we can determine what set of items we want to use to calculate the price for. In this case, I'm just going to do cost 04, and then I'll click OK, and it'll filter for just that one item. We also have the option to run this as a batch function to mitigate any performance issues that we might see when running for a large number of items. Once it's all correct, I will click OK, and the system is going to calculate my price for me. Now we can view the price by going back into our item price list, and we see that it's been added to the pending view. If we want to see the details on this price, we can go to the View Calculation Details form, and this will show us our top level price, which is 41 cents, and the components of this price. In this case, we have 2 components. We have the purchase price, which was 40 cents per unit, and then our costing sheet had an overhead of 2%, which adds an additional cent per unit to make our total value of 41 cents. So these level 1 are the components of our level 0 cost. Now that I'm happy with the price I've calculated, I'm going to activate my pending price by clicking Activate Pending Prices, and it'll move from the pending price view into the active price view. Now my price is active and ready for use on transactions. So let's talk through the process of cost maintenance, which is typically done on an annual basis, but in other cases may be more frequent. When we are preparing to establish the next set of standard costs that will be used in D365, the first thing we want to do is review the variances from our previous period. To identify costs that may not have been accurate, we would look for items with a high positive or negative total variance, which will tell us whether our standard was too high or too low. We also want to identify which items or processes have more variance. This does not always mean that the total variance will be very high or very low, since that's only a summary view. In this case, we would want to look at products where transaction variance amounts were very different from transaction to transaction. For example, we may notice that the amount of time spent in quality inspection of manufactured goods was very inconsistent and investigate to find that we had a large number of new employees in that past period, which led to this variance between transactions. Once we've understood the variances from our previous period, we will simulate planned costs for the next period. We can estimate the impact of changes in purchase prices or labor costs to our total costs, and what our sales prices would need to be to maintain our target margin. Once we've calculated the planned costs, you will want to review the outputs. We need to ask ourselves, does this align with our expectations, or why not? If there are small changes needed, we can identify and correct them, or we can choose how to run a new planned cost calculation using different estimated costs or calculation factors. Finally, when we are happy with the next set of costs, we can copy our planned costs to a standard cost costing version, which will allow us to then make our costs active in the system. Some businesses may skip the planned cost steps and simply run a calculation and activate their standard costs. Other businesses prefer to calculate standards outside of the system and load these pending costs via the data migration framework. With that, I'm going to turn it back over to Rachel.
Thanks, Ann. Now that you have a basic understanding of how to maintain your costs and costing versions, let's switch gears and talk about how to analyze variances for standard costs. For today's Tech Talk, we will only be focusing on purchase price variances. Other types of variances will be covered in our next Tech Talk. Going back to the example that we looked at the beginning of this session to help explain standard costing, let's take a closer look at how purchase price variances are calculated. In the first PO 123, you can see that there is a variance of -1. This is because the actual cost of the purchase order is $3, but the standard cost is $4. In the second PO 234, you can see that there is a variance of +2. This is because the purchase price is now $6. In each of these examples, the variance would be posted to the variance account. So let's take a closer look at an example in the system. Here you can see a screenshot of the subledger journal for a purchase order. This PO has one line for an item configured for standard cost. The standard cost has been set to be $4 and the purchase price was set to be $6. First, you will notice that the cost of purchased materials received has posted to the inventory account 140200 for the standard cost. This means that inventory on the balance sheet is valued at the standard cost. The $2 variance in this example is posted into the purchase price variance account, which in this example is 510310 on the profit and loss statement. So now let's take a look at how to configure the main account that's used for purchase price variances. Here you can see the inventory posting profile page. You can access this from the cost management module in the Ledger Integration Policies setup area. You'll need to first navigate to the Standard Cost Variance tab on the page. The first posting type or option that you see here is Purchase Price Variance. You'll need to make sure that this is selected, and then you'll add a row. You can select to use a different main account based on a single item, groups of items, or all items, as well as for cost codes. Table for the cost code is a specific cost group, where group is a cost type such as direct manufacturing or direct materials, for example. The last field is the main account field, and this is where you'll select the main account that you want to use. In most cases, organizations only have one account to record purchase price variances, so one all record is all that's needed. But in the case you need multiple accounts, you have that flexibility by item or cost group. Now, let's switch gears and talk about the variance analysis statement. You can find this report in the cost management module under the inquiries and reports area in either inventory accounting analysis reports or manufacturing accounting analysis reports. Both options open the same report. Here you can see the report dialog. and you'll need to select some report parameters. First, you'll need to select the date range for the report. We recommend that you configure date intervals, which can be found in the General Ledger module, to make the date selection easier. This is also useful when you run the report in batch, as the system will dynamically update the start and end dates automatically. If you don't select a date interval code, such as current period, you will need to manually enter the from and to dates. Next, you'll need to select the sorting and grouping option. There are 3 options for sorting and grouping. The first is item, which is what I'll select. This means that the report will output rows for the item group and item numbers. If you select the option for origin, this will create rows and grouping for the type of variance, such as purchase price variance, quantity variance, and so on. The third option is cost group. With this option, you'll see rows and grouping for the cost groups that you have assigned to the items. Next, you need to decide how the columns will appear on the report. You can choose between cost group type, which is the example I will use, and this creates columns for direct materials, direct manufacturing, and so on. If you select fixed/variable from the list, you will have 2 columns, one for fixed cost and one for variable costs. Remember that if you leave the behavior blank on the cost group, it will default to variable. The last option is position. When you select this option, you'll see columns for on hand, WIP, deferred, and COGS. This is most commonly used to analyze manufacturing variances, so you can see where in the process the variance came from. Next, you can choose the level of detail you want to see on the report. If you select no, the totals will be summarized by the rows and columns you have selected. You can also select decomposition and transaction. When you select decomposition or total, you can also select the level that you want to view. This is useful for BOM or formula items, and you can select an option between total, single level, or multi-level. For my example, I'm going to go back and select no for the level of detail. Once you've selected your report options, you can click OK to run the report. In my example, I have selected the report destination to be printing to my screen. And depending on how much data you have in your system and the date range and options you selected, the level of detail and so on, it may take some time to run. In most cases, we recommend that you run this report in batch mode so that the user doesn't have to sit and wait for the report to execute. Now that the report has generated to my screen, I'll zoom in so we can see it a little better. Here you can see a sample of the report with the options selected after creating 2 purchase orders for the standard cost item we just reviewed with different variances. You can see the quantity contribution is 2, and the variance amount is 387. The total amount shows under the direct materials column since all the variances are tied to an item with the direct materials cost group type. In addition to using the variance analysis statement, you can also view the details of costs posted for a product receipt or invoice, including the indirect costs, by accessing the posted transactions. Here you can see a sample of the product receipt journal lines. This is accessed from the purchase order by clicking the Receive tab in the action pane and then clicking Product Receipt in the Journals group. In this screenshot, we have clicked to the Lines tab to view the details. Here, you can view the details about the cost in one of 2 ways. By clicking the Purchase Cost Transactions button, which will show both the standard cost and indirect cost transactions for the PO, or by using the Purchase Indirect Cost button, which will only show the details of the indirect costs. For this example, we have clicked the Purchase Cost Transactions button. Here you can see 2 rows, one for the purchase cost of $39.20 and one for the indirect cost, which is 2% of the purchase price at 80 cents. Now I will hand it back over to Anne to wrap us up.
Thanks, Rachel. Let's talk about our resources and recommendations. We are back with the do's and don'ts list for standard costs in the costing sheet. On our do side, these first 2 go together. We do recommend that you block activation after you have activated your costs and that you block cost creation once you've completed your cost calculations. So those are the 2 block flags we talked about earlier. We recommend putting them to yes on your active costing version that's being used in this period to prevent unwanted changes to current prices. We also recommend that you prioritize flexibility and maintainability of the costing sheet when you're designing it for your implementation. You want to think about all the ways that your business processes might change or how you may need to add new cost groups based on the rules you're setting, and make sure that you're prioritizing, again, that flexibility and maintainability. We do recommend that you establish a periodic process for the maintenance and update of standard costs. If you set a standard cost once and then forget about it for 5 years, it's very unlikely that that cost is accurate, and your variances may be very high and won't be showing you good margins on your cost of goods sold. We recommend that you run cost calculations for large sets of items using batch processes to mitigate any potential performance issues from the cost calculations. On the don't side, the first one is the most important one. We do not recommend that you implement standard cost if it's not allowed in your region. Standard cost is not considered generally accepted by all governing bodies, so you want to make sure you check with your auditor and your finance department before you implement standard cost. In our first tech talk, where we covered general inventory costing setups, we talked about the fixed receipt price function on the item model group. We want to reiterate what we said in that tech talk, which is do not use the fixed receipt price as a replacement for standard cost. If you want to know more about that, please watch the recording from our first tech talk. We also don't recommend that you make too many costing groups. As Rachel covered in her slide with the lots of dollar signs, the goal of costing groups is to show a summary view of costs in a way that's easy for us to analyze and interpret. The more cost groups we have, the less of a summary view it becomes. We also don't recommend that you update your standard cost more frequently than necessary. Changing your standards constantly will make your variances harder to understand or less accurate. Don't forget to assign cost groups to all of your items and resources or resource groups. This will make sure that every source of cost in your business actually gets allocated to the cost sheet. So when we look at a cost sheet, we want to see all the details, and if we leave a cost group off an item, for example, then that item's cost won't be represented in the cost sheet. We also don't recommend that you omit cost groups from the cost sheet in the same way. So we may have the cost groups assigned to our items, but if it isn't on the cost sheet, we won't be able to see the cost of that item. Now let's talk about the resources that we have available for additional learning. We have a link here to part 1, and since this morning session, part 2 of our Tech Talk series has also been posted to the Dynamics Tech Talk page. We've linked to the cost management homepage on Microsoft Docs, which has various links about different areas of cost management in D365. We also have a link here to the Yammer Insider program, where you can ask other users and members of the product team and partners questions about cost accounting and cost management. And then we have the ideas site. If you have any feedback about the product that you'd like to share with us, please put it on the ideas site. We also have a link here to the conversion overview to go from anything to standard cost if you're live in D365. Rachel and I are planning on doing a follow-up video where we talk about this process in a little more detail, but we didn't have time for it today. We are looking for feedback on additional sessions. This is the current status of our votes. We've added some new options since the original form was posted, so please go to aka.ms/D365 Costing Tech Talks and vote on additional sessions you would like to see. And with that, that brings us back to the riddle of the day. What does the accountant do in his free time?
I don't know, Anne. What does the accountant do in his free time?
He journals.
I love it. Journals.
Yeah. All right. Let's go to our questions. We have a number. So a number of questions, so let's get into those. The first one, Rachel, is how do you suggest handling a scenario where the item is procured in multiple currencies?
Great question. So if you have an item that you purchase in multiple currencies, standard costs are not specified in more than one currency. You specify a default currency. When you set up, if you want to use trade agreements for your purchase prices, you can have different currencies and exchange rates. What's important is that you configure your exchange rates and keep them up to date and accurate so that the standard cost that you're using is going to be consistent, and the variances, more importantly, between your purchase prices and that standard cost are consistent. So that standard cost is always going to be expressed in a single currency.
Great.
Anything you wanted to add there, Anne? Or?
No, you did a great job. The next question, and I'll give this one to you, Rachel, is are posting profiles going to be covered in this series?
Great question, and thanks for asking about this. Obviously, we covered a very sliver of one posting profile today in our session. It is not something that we're planning to cover in detail in this series. However, I am working with another one of my colleagues on another series that will be coming out soon, along with lots of new docs articles all about posting profiles. So certainly keep an eye out for those in the future.
Thanks, Rachel. The next question is there a capability to treat purchase variances differently based on the site or warehouse?
Do you want me to take that?
Sure.
Sure. So when you set up standard costs or even default costs in a costing version, they are always site specific. And so that rule applies to your indirect costs as well. They're always going to be site specific. If you need a different cost by warehouse, you would need to make sure that you have that warehouse in its own site. There is no ability to specify standard costs or default costs by warehouse.
And I think too the question asked about variance, and if we're using standard cost, the posting setup will post all variances of a standard cost to the same account regardless of warehouse or site. Is that correct, Rachel?
Yes, that is correct. Variances are not site specific, but the costs themselves are site specific.
Okay.
Yeah.
Great. The next question is there a way to carry the variance from a general variance account to an order if project procurement is used? So I think in this scenario, we have a standard cost item that we're procuring, but we want the variance from the purchase price to be included in the project price overall.
Yeah, I'm not totally clear on the question, so if you want to reply back in and try to clarify a little bit more, we can certainly try to answer. I mean, whether a purchase order is just a regular purchase order or it's tied to a project, we're still going to recognize the standard cost and we're still going to recognize variances in your general ledger. There is not a way to have different GL counts based on like a project though for your standard cost variances. So if that answers it, great. If not, feel free to clarify more and we'll certainly try to get it answered.
I would also say if you're trying to get the full purchase price included in the cost of a project, then you might consider using an actuals costing method such as FIFO. And you might also consider marking to get the very specific cost.
That's a great point. Yep.
The next question, and I'll take this one, is there a way to define cost group and indirect cost based on site? So as you saw when Rachel showed the costing sheet setup, we can set a different indirect cost rate for each site. In fact, site is a mandatory field on an indirect cost rate. However, cost groups are assigned on the item level. So if you're assigning on an item or a resource, it's wherever that item is used, it uses that cost group. So, item in site 1 doesn't get a cost group with 1 versus item insight 2 gets a cost group 2. Anything you want to add, Rachel?
Nope, I think you explained that well.
Okay. The next question is, can we create overhead rates by product? Rachel, I'll let you take this one.
Yep, absolutely you can. To do that, you would need to create a cost group that is specific to a specific item, and then put that cost group in your costing sheet, and then define that indirect cost rate. We typically recommend that you group similar products together, but you never select like table and a specific item number when you defined your indirect costs.
So we would recommend that you create a cost group instead of creating a surcharge in record that has valid for item specific.
Yeah, so like in the costing sheet, when you're making the rate, like a surcharge or a rate, and you're specifying the 2% or the flat amount that you're wanting to add, there is no option to make it table specific to an item. It's always to a cost group.
There is actually, I think, Rachel.
Is there?
Yeah, so we have, there's a field, and it's a little different from how it normally looks. So it says valid for, so you can say this is valid for, and it defaults to all, which is all items. And then you can change that to be group or table, just like on, posting profiles or trade agreements, etc. So we can, within a particular indirect cost rate, define it for a specific item.
Great.
Okay. For the next question is, for production variances within a production structure or plan, are we able to flow this to the higher level object or the pegged order? So I'll take this one. When you use standard cost, the variance is going to get posted to a general ledger account at the transaction where it occurs. So if we have a multi-level production BOM, so we have, a top level production order and a subcomponent production order, and there was a variance on the subcomponent production order, that variance gets posted to the general ledger on the subcomponent. And when you issue that material to the finished good production order, that just gets issued at the standard cost. So we can cover this in some more detail in the next Tech Talk. Please come back and ask us your question again if that doesn't answer it fully. The next question is, how can we access recorded sessions of these Tech Talks? They are available on the Dynamic Communities Tech Talk page, which we can add a link to in the chat if we haven't already. All right, Rachel, this next one's for you. Any chance that the cost group profit setting will be used in the future for sales prices?
So if you are running a cost calculation, the profit settings can be used for that. Typically, in a lot of cases, people will run one cost calculation and update both. And if you want just your sales prices to use a profit setting, you'd have to run the process twice. So I think we've got an idea on our survey to kind of dive into that in more detail. So certainly go vote that idea up if you haven't already, so we can kind of dive into that into more detail.
Great. I know we still have a few questions left. Unfortunately, we are pretty much out of time. Unless, Rachel, is there any question that you want to tackle before we wrap up?